Hi everyone, welcome back to Future Studying. It is the 13th of April 2026. It's 9:13 in the evening. Today I'll walk you through the key developments in the APAC loan markets from early to mid-April 2026. But before we dive in, let me pose a question. Are we witnessing a temporary dislocation, or is this the beginning of a fundamental repricing of risks across the region? We have seen some significant shifts in the market of dynamics, headline transactions, and emerging themes that present both opportunities and challenges for participants in this space. So let's take a look at the macro picture, a market under pressure. Let me start by setting the scene. For those of you who have been in the market long enough, will remember the 2008 to 2009 credit freeze and the 2015 to 2016 China hard landing fears and the COVID-19 disruption of 2020. The first quarter of 2026 has been challenging. It has been difficult for syndicated lending in the region. But is it truly comparable to those prior dislocations? Loan volumes denominated in US dollars, euros, and yen for APAC, excluding Japan, totaled just $22.5 billion US dollars, a sharp 42% decline from 38.6 billion in the same period last year. This represents the lowest quarterly tally since the COVID pandemic in 2020. When we include major domestic currencies, the picture becomes even more stark. Total volumes dropped nearly 49% to 64.2 billion from approximately 200 deals, compared to 120 billion from 340 loans in the first quarter of 2025. This marks the lowest quarterly volume since 2012, and for those with longer memories, that was a period when European sovereign debt concerns were spilling over into Asian credit markets. What's driving this downturn? Well, the February 28 military action by the United States and Israel against Iran triggered concerns about rising oil prices and potential energy crisis. This added to existing headwinds from the US trade war and disruptions from artificial intelligence. M&A lending has been particularly hit hard, dropping more than half to 5.2 billion from just 13 deals in the first quarter of 2026 compared to 11 billion from 22 transactions a year earlier. Now, think back to 2021 and early 2022. We were swimming in a sponsor-backed M&A activity. What happened? The answer lies in the cost of capital and conviction. When your base rates moves 400 plus basis points in 18 months, deal economics fundamentally change. Now, despite the challenging environment, several significant deals move forward. And this is where it gets interesting, because the deals that are getting done tell us a lot about where capital is still flowing and why. Let me highlight some of the most notable. Let's take SoftBank Group's massive OpenAI investments. For those unfamiliar with SoftBank, this is Japan's premier technology investment conglomerate, best known for its vision fund and significant stakes in companies like Alibaba, ARM Holdings, and numerous AI startups worldwide. SoftBank signed a 40 billion one-year bridge loan for its investments in OpenAI, the second largest bridge facility in the APAC history. Think about that for a moment. The largest was the 46 billion for Broadcom VMware acquisition in 2022. Goldman Sachs, JP Morgan, Mizuho Bank, MUFG, and SMBC are the lenders. The loan pays all-in pricing of over 300 bips, higher than previous facilities, and the company is staggering its investments across three tranches. 10 billion by April the 1st, followed by two equal investments completing by July and October. Now, moving on, let's also take a look at Toshiba's LBO refinancing. For context, Toshiba is one of Japan's oldest and most storied industrial conglomerates, with business spanning semiconductors, nuclear energy, infrastructure, and electronics. The company ends its 74-year history as a publicly listed company in December 2023, following a leveraged buyout. JIP Japan Industrial Partners has completed a refinancing and a dividend recapitalization of around 1 trillion yen, Japanese yen, for its buyout of Toshiba. Now, this is a textbook example of how LBO economics should work, and frankly, how they rarely do in Asia. Mitsuho Bank and SMBC are the mandated lead arrangers, with MUFG and SMTB joining the same title. The new 4.5-year financing carries interest margins of around 150 bips over TIBOR, about half of the 300 bip margin on the original 1.4 trillion senior loan. This refinancing reflects Toshiba's improved performance, an 88% surge in operating profits for the 9 months ended December 2025, with earnings skyrocketed to a rocket 499 billion Japanese yen. The margin compression from 300 bips to 150 bips, that's your reward for operational execution, and this is what the risking looks like in real time. S&P upgraded Toshiba's rating from BB- to B+ in December 2025. Now, next up, let's take a look at KKR's Taiyo Holdings buyout. KKR, the global private equity giant known for pioneering leveraged buyouts since the 1970s and managing over 500 billion in assets, is raising approximately Japanese yen 250 billion, which is approximately US dollars 1.6 billion, to back its planned acquisition of Taiyo Holdings, a Japanese chemical manufacturer. Why does this matter? Well, Japan has historically been underweight in PE activity relative to GDP, and we're seeing that gap close rapidly. Osora Bank, BNP, KKR Capital Markets, and MUFG are among the lenders. KKR plans to acquire all shares at 4,750 Japanese yen per share through a tender offer in early October, valuing the transaction at 528 billion Japanese yen. Top shareholders, DIC, COA, Oasis Management, representing 42% of the outstanding shares, have agreed to support the privatization. Section 3. Let's take a look at the infrastructure and some ESG-linked financing. Here's a question worth considering. In a risk-off environment, where does capital seek shelter? Infrastructure, and specifically contracted infrastructure with inflation-linked returns. ADIA, one of the world's largest sovereign wealth funds managing assets for the Emirate of Abu Dhabi, closed a 4.75 billion, which is approximately US dollars 2.5 billion, whole co-financing for its portfolio of Australian infrastructure assets after attracting a blowout response from 28 lenders. The borrowing comprises a Australian dollars 2.2 billion 5-year term loan, Australian dollars 1.3 billion 7-year term loan, and several facilities. Interest rate margins are 100 bips and 200 bips over BBSY for the 5-year and 7-year tranches respectively. The assets backing this loan include minority assets in WestConnex, NSW Ports, Port of Brisbane, and the Transurban Queensland. And let's take a look at MIND-ID's mining sector loan, formerly MIND-ID. MIND-ID, formerly Mining Industry Indonesia, is the holding company for Indonesia's state-run mining companies, including Anika Tambang, Freeport Indonesia, and Vale Indonesia. The company launched a US dollars 1 billion 5-year loan at tighter pricing than its 2024 borrowing. Why the tighter terms? Well, sovereign-backed credits in strategic sectors are precisely what banks want on the books right now. The financing is split into a $300 billion US dollars term loan and a $700 million revolving credit facility, paying interest margins of 98 bips onshore and 93 bips offshore over SOFR. This comprises favorably to 2024's pricing of 125 bips onshore and 115 bips offshore. Well, next, let's take a look at the regional corporate activity. Wilmar International. It is one of Asia's leading agri-business groups, headquartered in Singapore, with operations spanning the entire value chain of the agricultural commodity business, from origination and processing to branding and distribution of edible oils, sugar, and grains. The company launched a dual tranche 5-year loan of up to $1.8 billion at tighter pricing than its previous borrowing. In a market starved for quality paper, names like Wilmar became the belle of the ball. The loan comprises at US dollars $1.2 billion revolving credit facility and $300 million term loan, offering 95 bips over term SOFR compared to 105 bips on its 2023 facility. Bank of China, DBS, HSBC, Maybank, and OCBC Bank and United Overseas Bank are the arrangers. And let's take a look at talk about where the structural tailwinds are. The Asian Infrastructure Investment Banks is ramping up climate financing with 67 of its total approved financing, which is approximately 5.6 billion US dollars, classified as climate finance in 2024, up from 60% to and 56% in prior years. AIB approved a US $300 million senior unsecured loan to International Container Terminal Services for boosting capital expenditure in its Philippine ports, including requirements to replace diesel-powered cranes with hybrid models. The bank is targeting private sector's financing to reach 50% of its annual approved financing by 2030. AIB invested $75.5 million US dollars in Keppel's private credit fund focused on mid-cap infrastructure companies across APAC. Separately, the Asian Development Bank launched a regional connectivity fund for energy in Southeast Asia with the initial funding of $25 million US dollars to develop the Asian power grid. ADB estimate Asian will need over $100 billion in transmission infrastructure investment over the next 2 decades. So let's take a look at let's talk about the opportunity. So where does this leave us? In every market dislocation, there are winners and there are losers. And the key question is, which side of that trade do you want to be on? Based on this analysis, several opportunities emerge. First, the private equity dry powder. Here's the elephant in the room. There's an estimated $400 billion of uncommitted PE capital in APAC. Record levels of PE dry powder and numerous portfolio companies ready for sponsor exits and refinancings create deal flow potential. This is evidenced by the planned Japanese yuan 500 billion private credit fund that Nippon Life Insurance and SMBC are discussing to support Japanese LBOs. And we are seeing a bifurcation reminiscent of 2009. Strong borrowers are securing tighter pricings while weak credits struggle. Wilmar achieved 95 bips versus 105 bips previously, and Mind ID obtained 98 bips onshore versus 125 bips on its 2024 deal. This reflects banks' desire to deploy capital amid reduced deal flow. Now, another opportunity would be to view it from the loan versus bond arbitrage perspective. In volatile markets, borrowers gravitate towards loans because they offer more optimal pricing. Over the next 6 to 9 months, banks are expected to refinance maturing bonds through loan facilities. And if you look at the infrastructure and energy transition, the Asian Power Grid Initiative and AIIB's climate financing create substantial opportunity in cross-border energy infrastructure. And big data center raised US dollars to 320 million from Central Bank Asia, Bank Permata, KB Bank for liquid-cooled AI infrastructure campuses in Indonesia. This facility will support the most advanced and power-intensive AI workloads being adopted by enterprises and hyperscalers. Now, but let's not be naive. Every opportunity comes with a risk profile, and frankly, if you're not thinking about the downside scenarios, you're not doing proper due diligence. Several risks warrants careful monitoring. Remember, first it's the geopolitical uncertainty. Remember 2022 when Russia invaded Ukraine and we saw an immediate contagion across European credit markets. We're seeing echoes of that playbook now. The Middle East conflict has put deals on hold. As one banker noted, we have some Middle Eastern deals under discussion, but these have all been put on hold. Resolution for the escalation signals would be needed for shelved deals to resurface. And another risk would be the interest rate uncertainty for sure. Cast your mind back to late 2023 when the market was pricing in 6 Fed cuts for 2024. How did that work out? The lack of visibility on US interest rate cuts makes offshore funding less attractive, and some clients have delayed expansion or borrowing plans due to elevated interest costs. Market expectations have shifted from a declining to rising interest rates, making borrowers more cautious. And there's also this AI disruption risk. Increasing risk aversion towards software and outsourcing models exists due to unquantifiable disruption on these business because of AI. And there is the benign credit environment borrowers enjoyed is expected to end. Terms including leverage, tenors, amortization, security, and pricing are expected to become more lender-friendly for deals requiring underwritten solutions. Underwriting risk is typically curtailed first during uncertain times. And there will also be currency and bilateral shifts because borrowers are moving more financing to local currencies and bilateral or club formats rather than syndicated deals. This reduces overall syndicated loan volumes and fee opportunities. In summary, while the first quarter of 2026 marked a difficult period for APAC loan markets, quality credits continue to access financing at competitive terms. History tells us that the best vintage years for private credit and PE often follow periods of market stress, say for example 2009, 2016 and 2020 all proved this out. The market is bifurcating between strong borrowers achieving tight pricing and more challenging names facing lenders' resistance. Key themes to watch include the resolution of the Middle Eastern tensions, U.S. interest rate direction, and the continued growth of ESG-linked financing and expansion of private credit as an alternative capital source. The final question I'll leave you with is this: are we at a cyclical bottom, or is this the new normal? The answer would determine whether the next 12 months represent a generational buying opportunity or a value trap. Thank you for your time, and this will be all for today. If you enjoyed this video, make sure to hit the like button, subscribe, and comment your nonsense below. I'll see you next one. Bye.